Over the nearly 20 years following the 2008 global financial crisis, the underlying architecture of the global financial system has undergone profound restructuring with the strict constraints imposed by Basel III and the Dodd-Frank Act on the capital adequacy ratios of traditional commercial banks. Conventional banks were forced to retreat from the higher-risk mid-market corporate lending segment. This regulatory vacuum was rapidly filled by non-depository financial institutions, giving rise to a vast Eden shadow banking ecosystem, private credit. As of early 2026, the assets under management in the global private credit market have expanded exponentially. Depending on the estimation methodology, its scale ranges from $1.3 trillion to a stacked $3 trillion. In an environment of more than a decade of zero interest rates and low inflation, the private credit market fostered a perfect illusion of boni, implicit guarantee, and rigid repayment. However, enter but 2026, this enormous financial ecosystem is now facing an unprecedented structural stress test. This report aims to deeply analyze the nonlinear fractures currently unfolding within the U.S. private credit market. The analysis indicates that this is not an ordinary credit cycle downturn, but a systemic re-rating triggered by the superposition of three major crises. First, the explosive emergence of generative artificial intelligence is fundamentally destroying the business model of software as a service companies, the largest underlying asset class in private credit. Second, the false collateral and fraudulent practices accumulated during the period of extreme expansion, such as the successive bankruptcies of First Brands and Trico, are now concentrating and exposing themselves. Finally, and most fatally, traditional banks have become deeply entangled with this crisis by extending trillions of dollars in credit and undrawn commitments to non-depository financial institutions, while panic redemptions by retail investors are triggering a liquidity death spiral. Faced with this complex web of systemic risks, global capital is undergoing a dramatic macro flight to safety reconfiguration. This directly explains why, during 2025 to 2026, precious metals such as gold and silver, assets carrying no counterparty risk, have experienced a historic re-rating in price. To understand the fragility of the private credit market, one must first examine its underlying collateral assets. During the leveraged buyout boom from 2015 to 2025 to 2020, firms spent more than $4,400 billion acquiring over 1,900 software companies. The underlying logic of this acquisition frenzy was extremely robust. Software as a service businesses enjoyed very high customer switching costs, predictable recurring revenue, generous gross margins, and an asset-light operating model. Based on these NMA certainties, private credit funds provided massive unit ranch financing for these acquisitions, often predicated on price to sales multiples as high as 20 times or even higher. As a result, the software sector has become the single largest risk exposure in this $3 trillion private credit market. Statistics show that approximately 22 to 5% of all private credit transactions are concentrated in the software as a service domain, with total credit exposure ranging from $600 billion to $750 billion. However, the rapid commercialization of generative artificial intelligence, especially agentic AI capable of autonomous execution, is delivering a dimensionality reduction attack on the software as a service model. The profitability foundation of traditional software as a service software lies in B per seat pricing, whereby enterprise clients pay subscription fees for each employee using the software. But as AI agents begin replacing humans in performing complex tasks, such as code writing, legal document review, and customer service processes, enterprise demand for software PRCs has experienced a cliff-like collapse. Public market pricing mechanisms, being the most sensitive, have already responded brutally to this technological disruption. In early 2026, the S&P Software and Services Index evaporated brought $2 trillion in market capitalization in an extremely short period. The sector's average price to sales multiple has been mercilessly compressed from a peak of 9 times to 6 times, reverting to mid-2010s levels. Taking Figma and Naven as exam, The former, while still maintaining 40% revenue growth, saw its share price plummet 80% from a high of $43 to $24 below its IPO issue price. The latter had its stock halved by 60% within less than 4 months of listing. In contrast to the violent re-rating in public markets, the private credit market suffers from severe bid-valuation lag because these loans are highly illiquid. Level 3 assets. Their net asset values are typically assessed internally by fund managers using proprietary models rather than market fair values. This mechanism gives fund managers strong incentives to mask losses during downturns. To avoid triggering debt covenant breaches, private credit funds have heavily employed payment in kind BLK provisions. BLK allows cash flow stressed software as a service borrowers to defer cash interest payments by rolling the due interest directly into principal. Data indicate that from late 2025 to early 2026, BLK interest as a proportion of total investment income for publicly traded business development companies has surged to historic highs of 8% or Easton 0.3%. This practice essentially uses future leverage capacity to purchase present survival time. The core sustained metric for debt is the interest coverage ratio under the impact of artificial intelligence. Software, as a service company's revenue growth, has stalled or even contracted, while principal balances inflated through BK cause future implicit interest expenses to rise geometrically, accelerating the deterioration of interest coverage ratios. Although headline default rates remain below 2%, when selective defaults and liability management exercises are included, the true default rate has already approached 5%, a massive hidden hazard lurking beneath the surface. Even more alarming, the latest research report from Rubles points out that under an bid and aggressive disruption scenario triggered by artificial intelligence, existing software as a service business models will be rapidly phased out, causing default rates in the U.S. private credit market to spike to 15%. This figure is more than 3 times the expected default rate for traditional high-yield bonds and is sufficient to trigger a systemic collapse of confidence as of February 2026. The total volume of distressed technology sector debt, loans trading below 80 cents on the DA, has surged to $46.9 billion, including massive private credit packages tied to one-star companies such as Citrix, Coupa Software, and Zendesk. The collapse of underlying logic has become an unavoidable time bomb for the private credit market. If artificial intelligence disruption of software as a service constitutes an external macro shock, then the internal erosion caused by the loss of due diligence standards and the proliferation of fraud within the private credit industry represents a fatal decay from within. In recent years, amid an environment of too much money, chasing too few good deals, major private credit funds engaged in fierce race to the bottom competition to deploy the enormous capital they had raised, resulting in the widespread adoption of BNA covenant, LITA, loans and due diligence on collateral that was effectively perfunctory. This systemic vulnerability was brutally exposed in a series of major bankruptcies from late 2025 to early 2026. These cases were not driven by macroeconomic recession or operational failure, but by pure structural fraud. The dramatic collapse of global automotive electronic parts giant First Brands Group is a textbook example of this credit farce. In September 2025, the company formally filed for bankruptcy protection. Shockingly, this enterprise, with reported annual sales of $5 billion, had owned $12 million in cash in its corporate bank accounts at the time of bankruptcy, yet carried an astonishing debt burden estimated between $9 billion and $50 billion. First Brands' fatal maneuver involved extremely opaque off-balance sheet supply chain financing. Beyond the $61 billion of traditional syndicated loans on its books, the company had borrowed tens of billions of dollars in off-balance sheet funds from various non-bank institutions using accounts receivable and inventory documentation. Subsequent federal indictments revealed that company executives were alleged to have fabricated as much as $23 billion in fictitious accounts receivable. Even more serious was the Bono double pledging problem due to the absence of a centralized clearing and collateral registration system, akin to that in public securities markets. First, brands pledged the same batches of automotive parts inventory or accounts receivable to two or even multiple different credit providers simultaneously. When the funding chain broke, all lenders discovered that the collateral they held had already been claimed by others. The same fraudulent pattern repeated itself with subprime auto lender Tricolor Holdings. As a provider of vehicle loans to low-credit borrowers, Tricolor filed for Chapter 7 liquidation bankruptcy in 2025. Federal Bureau of Investigation and Federal Deposit Insurance Corporation filings show that Tricolor's chief executive orchestrated a systematic scheme, double pledging the same pools of subprime auto loans to different Wall Street banks and private credit providers, while altering underlying asset data to conceal large volumes of already defaulted loans. This crisis is not confined to the United States. Its toxicity has spread globally. In February 2026, UK-based major bridging lender Market Financial Solutions entered administration. The firm had a loan book of approximately £24 billion, but allegations of double pledging underlying real estate assets created a massive collateral shortfall of up to £9.3 billion for its institutional funders, including Barclays, Apollo, Global Management, and Jefferies. Veteran risk analyst Christopher Whalen succinctly summarized this industry chaos as the bon pupoi problem, using newly borrowed private debt principal to pay principal and interest on old debt, in a regulatory blind spot lacking transparency. Once the Ponzi-like asset bubble is punctured, the entire credit supply chain's value can be wiped out overnight. Optimists have long argued that even widespread defaults on private credit would not trigger a systemic run on the traditional banking system, as in 2008, because the funds come from institutional investors and high-net-worth individuals rather than ordinary depositors. However, data released by the Federal Deposit Insurance Corporation in early 2020 completely shattered this benefit-fire illusion. Traditional commercial banks never truly exited the high-risk, leveraged market. They merely changed their approach from lending directly to companies to lending to the funds that lend to companies. In regulatory terminology, this is known as lending to non-depository financial institutions. The Federal Deposit Insurance Corporation's detailed report reveals that since the 2008 financial crisis, lending to non-depository financial institutions has been the fastest growing credit category in the entire U.S. banking system. From the first quarter of 2010 to the third quarter of 2025, outstanding loans to non-depository financial institutions exploded from a mere $56 billion to Chopper $1.32 trillion. This represented a compound annual growth rate of 21.9%, nearly 3 times faster than the next fastest loan category. This $1.32 trillion exposure is not only enormous, but also highly systemically dangerous, as it is heavily concentrated in the hands of a few super large, systemically important banks. Data show that, as of the third quarter of 2025, banks with assets exceeding $100 billion held 86% of the institution loans, while the top 10 megabanks monopolized 71% of the exposure. For these giants, non-depository financial institution loans as a proportion of Tier 1 capital and credit loss reserves had skyrocketed from 5.7% in a 2010 arrive to 6 to 8.1% in the third quarter of 2025. If the $1.32 trillion of on-balance sheet loans already represent a sword of Damocles hanging over Wall Street, an even greater risk lurks off-balance sheet due to the operational characteristics of private credit funds and business development companies. They rely heavily on revolving credit facilities provided by traditional banks to manage funding turnover, meet capital calls, and satisfy retail investor redemptions. The Federal Deposit Insurance Corporation warned that, as of the third quarter of 2025, U.S. traditional banks had extended $9,870 billion in undrawn commitments to the non-depository financial institution ecosystem. This means that if the private credit market faces the 15% software as a service default wave predicted by UBLS, or encounters massive retail investor redemption runs, these private institutions will inevitably draw down these near $1 trillion of credit lines collectively and simultaneously in a desperate bid for self-preservation. Such behavior would instantly transmit the liquidity crisis from the lightly regulated BN shadow banking system into the heavily regulated traditional deposit-based banking system. Banks would be forced to drain their own liquidities reserves under the worst possible market conditions to meet these drawdowns, thereby triggering a comprehensive credit contraction that spills over into the real economy. The critical variable turning theoretical extrapolation into real detonation is the reversal of behavior on the funding side in recent years. To sustain relentless growth in assets under management, Wall Street's top asset managers have packaged private credit products into non-traded business development companies, or interval funds, and aggressively marketed them to high net worth retail investors. These products sold retail investors a highly seductive myth. The ability to enjoy high yield returns from the private market while obtaining bien semi-liquidity, typically promising quarterly redemptions of up to 5% of net asset value. Yet this is an extremely fragile maturity mismatch in financial engine alpha. The liability side promises quarterly liquidity, while the underlying assets are long-dated corporate loans, 5 to 7 years, with virtually no secondary market buyers in a crisis. When macro fears surrounding artificial intelligence, disruption, and rising bad debts erupted in the first quarter of 2026, retail investors' collective panic completely shattered this mechanism. In early March of 2026, the world's largest asset manager, BlackRock, faced a landmark liquidity run. Its flagship $26 billion private credit fund, HPS Corporate Lending Fund, TIC, Elendak Recipe, were seeing $1.2 billion in withdrawal requests in the first quarter of 2026, represent 9.3% of the fund's total net assets. Faced with redemption pressure of 9.3%. If BlackRock had chosen to force sell underlying loans at steep discounts in the secondary market to raise cash, it would have triggered a collapse in reported net asset value. Therefore, BlackRock was forced to invoke the contractual debt-cating provision, strictly enforcing the 5% redemption cap and ultimately paying out only $620 million. With nearly half of the requests frozen. After the announcement, BlackRock's stock price fell more than 7% in a single day on the New York Stock Exchange, sending a clear signal to global markets that liquidity in private credit had become critically strained. If BlackRock's cating was a serious warning, then the ordeal faced by alternative asset giant Blue Owl Capital, with more than $300 billion under management, was a full-blown crisis. In the fourth quarter of 2025, Blue Owl's Technology Income Fund, OTIE, had already endured $527 million in redemptions, approximately 15.4% of total assets. In February 2026, redemption pressure overwhelmed Ednaja $1.6 billion retail fund, Omindicher Pop 2, after failing to merge the fund with another listed vehicle. Due to the listed fund trading at a 20% discount, Blue Owl made a shocking decision, permanently closing the quarterly redemption window for BLK 2. This effectively unilaterally tore up the Guinness semi-liquidity promise made to retail investors, forcibly converting the fund into a gradually liquidating drawdown vehicle. To placate angry investors and raise funds for repayments, Blue Owl was compelled to cede $1.4 billion of high-quality direct lending assets from its 3 business development companies at near-par prices to North American pension funds and insurers. This event caused Blue Owl's stock to plunge to 60% over 13 months and set a record for the longest consecutive 11-day decline since listing. Blackstone's Bishred was similarly spared no pain, forced to temporarily raise the redemption gate from 5% to 7%, and even deploy $400 million of corporate and employee capital to weather the crisis. These events provide ironclad proof that the financial experiment of using extremely illiquid assets to satisfy retail investors' demand for liquidity has gone bankrupt. Capital is opportunistic and risk-averse. When a $3 trillion private credit market becomes mired in artificial intelligence, valuation resets, underlying credit fraud, bank liquidity squeezes, and retail stampede style runs, global institutional capital must seek a safe harbor free of counterparty risk. This is precisely why from 2025 to early 2026, precious metals, led by gold and silver, have exhibited a historic independent rally completely detached from traditional U.S. real interest rates and inflation frameworks over the past year. Gold has redefined what constitutes a bull risk-free asset amid fractured global BLK landscapes. Concerns over unbounded U.S. fiscal deficits and fears that shadow banking turmoil could drag down traditional banks. Demand for hard assets has exhibited irrational fervor. At the end of January 2026, spot gold decisively broke through the $5,000 psychological barrier, reaching an all-time high of $5,589.38 per ounce, and delivering more than 100% gains in just 12 months. Although profit-taking and a brief dollar rebound caused prices to consolidate technically to $5,298 and $5,400 in early March, the underlying macro drivers of the rally remain entirely intact. The most critical buying has come from price-insensitive global central banks. In pursuit of structural de-dollarization strategies, central banks maintained an average quarterly net purchase pace (ACE) of 585 tons of physical gold in 2025 and 2026. This sustained sovereign-level bid has constructed an exceptionally solid floor for gold prices. Faced with this paradigm shift, Wall Street as top investment banks have aggressively raised their long-term price targets. J.P. Morgan's global commodities team stated that due to the shift in reserve currency paradigm and significant diversification away from high-risk credit assets by investors, gold is expected to reach $6,300 per ounce in the fourth quarter of 2026, with its long-term baseline forecast raised by 15%. Goldman Sachs likewise lifted its year in 2026 target to $5,400, explicitly noting that high net worth family offices are aggressively accumulating physical gold bars to hedge implicit financial system risks as a higher beta proxy for gold. Silver exhibited even more extreme performance into 2026 because the silver market is smaller and deeply embedded in key industrial applications such as photovoltaic power generation, electric vehicles, and artificial intelligence data center hardware. It possesses dual attributes of BA2 safe haven and ADN industrial necessity. In the early year frenzy, silver prices briefly touched $120 per ounce before undergoing a paresis for ounce percent violent correction, oscillating sharply between $80 from late February to early March. Yet silver's support derives not merely from sentiment, but from severe physical spot shortages. According to market data in early March 2026, the COMEX faces enormous delivery press. Open silver futures contracts awaiting delivery correspond to 52.6 million ounces of physical metal, while registered deliverable inventory in the exchange stands at only 86.1 million ounces. This extremely fragile deliverable to contract ratio could trigger an epic short squeeze against Wall Street shorts at any moment. On this basis, J.P. Morgan issued an extremely aggressive forecast, projecting that CBS average price in 2026 will reach $81 per ounce, twice the 2025 average. Cetip Morale went even further, setting a near-term target squarely at the $100 mark, synthesizing the comprehensive analysis encompassing technological disruption, corporate bankruptcy data, bank underlying exposures, and precious metals flow trajectories. The $3 trillion U.S. private credit market is undergoing not a temporary bout of pain, but an unavoidable structural re-rating from the inside out. The core conclusions we observe are as follows. First, the systemic devaluation of underlying collateral is irreversible. Under the relentless crushing force of generative artificial intelligence, the moats of traditional software as service enterprises built on human augmentation, are disintegrating. This directly invalidates the cash flow assumptions underpinning $600 billion to $750 billion in private loans. Relying on payment in kind to paper over the cracks merely lengthens the fuse of the time bomb, making the eventual explosion far more destructive. The extreme default expectation of 13 to 15% is not alarmism. It is a rational extrapolation based on business model obsolescence. Second, the lie of the gold illiquidity premium is now backfiring on the entire industry. Asset management giants attempted through business development, company vehicles to sell extremely difficult, to monetize long duration private loans, to retail investors craving liquidity. The events of BlackRock Glen being forced to gate redemptions and Blue Owl OBC2 permanently locking its redemption channel mark the bankruptcy of this business model. In a crisis, no liquidity buyers exist capable of absorbing such massive volumes of distressed assets. Third, the traditional banking system cannot remain unscathed. The Yamad double pledging, fraud exposed by First Brands and Tricolor, demonstrates that, due to a lack of transparency, credit ratings and risk controls in the private market are effectively non-existent. More fatally, Federal Deposit Insurance Corporation data show that traditional banks are firmly lashed to the private credit chariot through $1.32 trillion in non-depository financial institution loans and near $1 trillion in undrawn commitments. When private funds face redemption death spirals, they will inevitably draw massively on bank credit lines, instantaneously transmitting liquidity stress to the nerve center of the entire financial system. In this epochal shift of capital paradigms, the direction of capital flows provides the most honest answer. Confronted with a morass of fraud, inflated valuations, and extreme lack of transparency in credit assets, the worded smartest money is accelerating its exodus, pouring relentlessly into hard, unencumbered physical assets, led by gold and silver, as well as the data center infrastructure that truly controls artificial intelligence compute power. This slow motion crisis of financial restructuring has only just begun. Soon, the failure of a major private credit firm may emerge. Everyone is advised to remain vigilant and prepare accordingly. The foregoing content represents personal reflection only and is not investment advice.